If gold even went well above 8,000 to get to another eightfold move, it would only be matching the same dimensions it's done twice before in the last 50 years. The difference this time in our assessment is the technicals and fundamentals are far different, far more bullish for gold and for monetary metals than they ever were. We could be 500 bucks, just the dimension of the range. So if you look at a chart in an old orthodox way, a range, top to bottom, what's the dimension? You add that to the breakout level, and that's your swing objective. Well, in this case, you're talking a tenfold move from the bottom of the range to the top. Well, a tenfold move getting above 50 means you could go to 500 just to match the dimension of the ratio moves that have persisted for 50 years.
The long-term price structure in precious metals is being badly misunderstood. What looks extreme on a short-term chart is actually modest when viewed in historical context and through range analysis. Michaeloliver, a veteran momentum and technical analyst, explains that if gold were to move well beyond $8,000, it would not represent excess. It would merely match the same eightfold advances gold has already achieved twice over the past 50 years. The difference today is that both the technical setup and the fundamental backdrop are materially stronger than in those prior cycles. Using classical range measurement, the current base spans nearly a tenfold move from bottom to top. When that range is added to the breakout level, the implied swing objective becomes much larger than most investors expect. Applied to silver, a breakout above the long-standing ceiling near $50 projects potential moves toward $500 to match historical ratio behavior. These are not forecasts, but mathematical consequences of multi-decade structures finally resolving. Now, we present the clips from Michaeloliver's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Top chart shows gold price since 50 years ago, okay, since it was legalized in the US. And it's priced, it's a price chart only, not momentum, but it's scaled on a ratio basis, a logarithmic scale, so that a move, for instance, the 76 low in gold was just above 100, and by 1980 it reached 850. Okay, that's an eightfold move in price. Eightfold gain from bear low to bull high. And lo and behold, if you go back to 2001, gold made a low at about 260. And by 2011, a different span of time, 10-year move, it was an eightfold move. Same dimension as the first one on a ratio scale. And then we've started our bull market from the bear low in 2015, which for gold was $1,050 in US dollars. And right now we're only fourfold gain. So when you stand back and look at this and say, well, inhale, exhale, we're only halfway inhaled here compared to the two prior bull markets on a dimension move. So, if gold even went well above 8,000 to get to another eightfold move, it would only be matching the same dimensions it's done twice before in the last 50 years. The difference this time in our assessment is the technicals and fundamentals are far different, far more bullish for gold and for monetary metals than they ever were. Hence, going back to 8,000 would be just a yawn. Oh, we've done it twice before. Big deal. Don't even expect 8,000 to stop it, but we're just pointing that out because people think, gosh, if you look at an arithmetic chart of gold, a normal everyday chart, you think, oh my gosh, it's left the page. No, it hasn't. It's only half the dimension of the prior two bull markets. And that's what brings us highly focused now to the chart below that on the same page. Silver, 50 years of silver. Unlike gold, which the 1980 surge was a tenfold move from the bottom of that range to the top, much of it compressed in the last 2 quarters of that bull move. Then it came all the way back down to the bottom of range and duplicated the same thing again in 2011, but it wasn't a new high. Gold was making a much higher high than it made in 1980 when it got to its high in 2011. And yet silver, while it had a big move from the bottom of that 50-year range to the top, it was just duplicating the same price that it was in 1980, 30 years later. How come? It moves with gold. It goes up and down with gold. No issue about that. But why couldn't it go up above the high of 1980 like the same dimensions the gold did? Okay, now we've broken out, fine. And on this log scale chart, if you did what gold has done twice before, now maybe is doing a third time. If you took the prior move in silver on a ratio scale and added it to the point of, We could be $500, just the dimension of the range. So if you look at a chart in an old orthodox way, a range, top to bottom, what's the dimension? You add that to the breakout level, and that's your swing object. Well, in this case, you're talking a tenfold move from the bottom of the range to the top. Well, a tenfold move getting above 50 means you could go to 500 just to match the dimension of the ratio moves that have persisted for 50 years. And why has silver been confined for 50 years while most other markets have not? Copper hasn't, lead hasn't, gold certainly hasn't. I think silver's headed now for a new reality. And old notions of what's expensive or what's overbought, throw them out the window. And I think a lot of this move that other arrow I've got plotted there could occur in a matter of a couple quarters. Not that ultimately go to 500, let's say, in a couple quarters, but to easily go to a couple $100. And that's our bet. I bet that sometime by the second quarter, we'll do that. And how do we time that? If you go back a couple pages, I'll show you where we set the clock. Spread charts tell you. Keep going. More. Okay, now let's go to the top of that page there. No, go one more page even beyond this. It makes another major point. One more page there. This page shows charts that measure the monetary metals, gold, silver versus the stock market, gold versus the stock market, and even the gold and silver miners. But the top chart here shows, going back to 2013, each month we take the close of gold and divide it into the S&P price and express it as a percent, and we plot it. Okay, so these are monthly closes going back, to 2013. It's when gold was really collapsing back then. Also in relative performance, it was coming down. But since about 2015, you see the price action, the spread action has basically been either side of 50%, been above it and below it, above it and below it, but sort of really going sort of sideways. So gold's been hanging in there versus the S&P, been doing as well. November's close broke out above that 4-point, very gradual downtrend line that capped off this relative performance chart for 11 years. It broke it out in November. Well, of course, in December, gold had a good up month, while the S&P had a slight down month, I think. The spread went even further in December. But that chart has just now broken through huge wide base. This is the start of something, not the end of a bull market. This is telling you that the money flow into gold, while it's been very strong over the last few years, was still within the range. And it's only in November that it finally broke out, in December even more so, and said, I'm out of here. What it's telling you is money is starting to shift from the stock market to the gold market. It's actually been going on since 2024 when you were near the bottom of that. But now it's broken out. So this is effectively a fresh buy signal telling you, if you're an investor, should you be in gold or the stock market? It says, yeah, you should be in gold. It's just begun. Okay, scroll down to that next chart right below there. Silver versus S&P. Also in November, it broke out over a similar basing pattern and relative performance to the stock market. That arrow shows where it was in November. Look at the December close. Whoosh, even further. So silver has also said, I'm out of here, freshly so, versus the U.S. stock market. This is not a late signal. This is an early signal.
Gold and silver are misread when viewed on standard price charts rather than on long-term logarithmic charts. On a ratio-scaled view, gold's past two bull markets both delivered clean eightfold moves from bear market lows to cycle highs. The current advance, measured from the 2015 low, has only completed roughly half that historical dimension, meaning even prices well above prior milestones would align with precedent rather than signal excess. Silver's story is even more striking. For nearly 50 years, it remained trapped in a broad range while other metals advanced into new price realities. That confinement has now ended. The recent breakout on a logarithmic basis implies a potential tenfold move from the base of the range, placing multi-$100 levels within the scope of historical symmetry rather than speculation. Relative performance charts versus equities confirm this is not a late cycle move, but the start of capital rotation into monetary metals. Let's get back to the interview.
Even if you took an arithmetic price chart of silver and you measured from lows that were $4 and $5 during the last 50 years and highs that were both at 50, you've got like a $50 range there almost. Well, add 50 to 50, the breakout point, you got 100. So even on an arithmetic scale, silver should just go to 100 just to match the simple arithmetic scale. But I'm arguing on the log scale, it's likely to do that. And also reprice itself fairly versus its real dollar value. And remember, you look at an M2 chart and look at the massive increase in the money supply since 1980 or even since 2011. And if you try to match silver to simply match the decay in the real buying power of the US dollar, silver would be in the hundreds. Okay. So you need to keep that in mind if you're considering participating or you're already in the monetary metals, is about to shift out of the bubble and the enthusiasm that's wrapped all around that bubble. And by the way, it hasn't always been AI. AI has been the leader for the last couple of years of that now 16-year-old bubble market, stock market. Just like in the dot-com era, in the latter years, the internet stocks were the leader. And when the market turned, they weakened first in a subtle way. While the S&P stayed firm, the NASDAQ 100 started to ooze a bit. Nobody noticed this. And it wasn't until the spread relationship between the leader, NASDAQ 100 back then, 2000, representing .com, and the S&P started to break down where that relationship started to weaken. Not so much the price chart breakage in NASDAQ, but just the spread between it and S&P. That's when the market started to cave. It's been late 2000. We're starting to see some of that now, where over the last couple months, NASDAQ has been anemic compared to the S&P. And I know a lot of investors out there have said, oh, this is good rotation. The market's finding new leaders. The game doesn't work that way. When you rotate out of the leader in the latter phases, that's a bad sign. And yes, there will be things that do better than AI. Like, look at NVIDIA now compared to its high, compared to S&P compared to its high, or financial sectors closer to its high than NVIDIA is. Those are going to break. But as far as other places to be, I think the world's going to shift their attention and then their emotions more from the paper assets that they've been bubbled all about for the last couple of years, especially into things under their feet, in a way to put it crudely, grains on the dirt, metal under the ground, oil under the things that are real, they can touch, and leave behind the things that are breaking. And I think it's going to be not only an investment shift, but I think there's going to be emotion attached to it as well, where people suddenly want to have something that, a bar of silver makes you feel pretty good, especially if it, has doubled over the last 6 months or so, you get my point. I think those are the places I'd be. Monetary metals, but also, though not the same bang for the buck, but basic commodities and stock. The other one's the dollar. The dollar has broken all of our long-term momentum trends. The only thing that's hanging on there's a trend line on the price chart. You could go back to 2008, and any idiot could draw it. And you're hanging in clustered, anemic on that line. But momentum has already broken its massive trend lines that go back to 2008 as well. Momentum is usually right, and it usually leads price. That market, while it's been quiet for about 6 months, I'm talking dollar index, which is really the euro upside down and the yen combined. It constitutes 70% of our index. And, there are pieces of fiat as well. So you're measuring crap versus crap, pardon. But if that market starts to accelerate on the downside, the dollar decline, and the T-bonds start to break their supports, those are headlines the public doesn't want to hear or see because these markets are huge. They dwarf the stock, especially the T-bonds. So that's something I'd be watching as a factor that not only damages the stock market, but panics the central banks, not just ours, into full print mode, meaning what? Gold and silver benefit.
Silver does not need extreme assumptions to justify much higher prices. Even on a simple arithmetic chart, measuring decades of trading between roughly $5 lows and $50 highs produces a range that already points to $100 to match historical structure. On a logarithmic scale, the case strengthens further, especially when adjusted for the massive expansion in M2 money supply since 1980 and 2011. Matching silver's purchasing power to today's dollar implies pricing in the hundreds. At the same time, leadership is quietly breaking down in overextended equity sectors, while tangible assets begin to attract capital. Momentum in the dollar has already failed, bonds are vulnerable, and any acceleration there would force central banks toward renewed liquidity. That environment historically favors monetary metals. This is not speculation, but a structural repricing phase unfolding in real time. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.